Here's euro dollar. This is its weekly chart. And all of this price action back and forth in here, even though there's sell side liquidity resting below this, it's being met with high resistance. So high resistance liquidity runs, they can still deliver and go below here, but high resistance liquidity runs are very frustrating sometimes for individuals that don't know how to anticipate them or don't know what they are. So I teach you in my concepts to identify what a high resistance liquidity run is, so that way you can understand the distinctions between that and a low resistance liquidity run. Low resistance liquidity runs are high probability and they are immediate gratification. They just immediately run to your objectives. It's very fun to trade them. It's almost immediate feedback once you get into the trade, whereas a high resistance liquidity run is a trade that's met with a lot of resistance in getting to where your objective may be. Now, because I'm calling it a high resistance or low resistance doesn't mean that it's resistance in the sense of support or resistance from the perspective of a retail theory. It's resistance in the form that it's very hard for it to be one-way delivery. So it's going to be a lot of consolidation, move a little bit, come back, retrace much more than you're probably comfortable, and then consolidate more, and then go a little bit further in the direction you were hoping for. That's high resistance. So if a new trader or a break-even trader, someone that makes a little bit of money then loses it, when they are met with those kinds of conditions in the marketplace, it tends to create very sporadic emotional responses in their psyche. They become agitated. They will many times get stopped out because they want to move their stop loss too aggressively too soon, or they're afraid they're going to get stopped out and they open their stop loss a little bit further, and it runs for that as well. And they regret having moved their stop to a larger stop loss. Understanding what a high resistance liquidity run is will help you filter those types of trades out. It doesn't mean you can't trade them or paper trade them or tape read. It just means that you don't want to be putting a lot of emphasis on trading in those environments, but more specifically, waiting for low resistance liquidity runs. Right, here's the daily chart in here. You can see how we've hit that bearish order block I mentioned the last time we spoke. Hit it. Now we're just consolidating inside of that gap right there. Now look at all the back and forth here. Up, down, up, down. So it's being met with that in the form of high resistance. Now, can this go higher with the dollar going lower? Absolutely. Can it work its way through this area here and attack the sell side below it? Absolutely. But because it's not one-sided, because it's not so heavy-handed, or because I can justify both sides of the marketplace right now, it's a neutral position for me. That means I want to only be trading when it's high probability and with low resistance liquidity run signatures. That means that the market is more likely to run quickly right to where I think it's going to go, either it be a liquidity or a inefficiency. So if I'm looking for lower prices, and if I was being honest with you, gun to my head, I think the dollar is going to go higher, and I think eventually euro dollar will attack these lows in here. Will it meet it before running out this high? That I don't know. But because I don't know that, I'm sitting still with my hands in my pocket, not willing to do anything. But every time I sit down with you, I'm always going to tell you what I believe is likely to occur. If I'm being forced into a corner, say, okay, ICT, what is it you think is going to happen right now? Regardless of whether you want to take a trade in it, what do you think is going to happen? And that's what I do. I like giving commentary and analysis when the market is one-sided and it's in low resistance liquidity run signatures, because it's very pleasing for me to share it and then you watch it happen in your charts. Right now, we don't have that. Okay, a lot of objectives have been met recently, both in dollar and euro and index futures. So we have to let the market consolidate. In month one of my mentorship core content on my YouTube channel, I introduced the idea of the 4 stages of price delivery, and consolidation, expansion, retracement, and reversal. Those 4 stages of price delivery, we are in now a consolidation. So we have to wait. You have to simply wait. You don't want to push the envelope here and try to predict what it's going to do when it's like this. It's easy to predict where price is going to draw to when it's one-sided in a low resistance liquidity run. That means it's very easy to see one side, either a buy or a sell, and very, very difficult to justify the opposite side of the marketplace. So an example would be, let's assume that the market only had one single low swing and not the back and forth trading range that we have in this area here. So price has spent a lot of time working in this range here. So it's going to take a real significant price move to get down below it. So if it were only a single low and then reverse, like a V bottom type thing, then it would be very easy to assume that this would continuously move lower, and then it would be a low resistance liquidity run short. And then obviously the opposite should be seen for a long in the dollar index. But because we don't have that, we have to sit and wait for more information. Otherwise, you're trading with low probability. Can you make money? Possibly, but it's more likely that you'll be wrong. And because I'm teaching you the distinctions between high resistance and low resistance liquidity runs, if you do engage it and you lose, you'll regret having done so, because I've already told you now it's lower probability.